Okay, good morning. So, today we're going to be talking about liabilities. Up to this point in the class, we've gone through the balance sheet, through the assets. We started with the current assets, cash, receivables, inventory, that kind of thing. Then we moved our way down to property, plant, and equipment. And now this week's chapter is liabilities. And liabilities are split up into current liabilities and long-term liabilities. And we're going to start with which one of these is not a liability. And so there's some that right now that you can look at and go, well, I know they're a liability. We have interest payable and taxes payable. Those are both easy to identify liabilities because they have the word payable in it, and that denotes that we've got to pay someone. A liability is a debt to someone else, something that we owe, an obligation we have. So now we get to the other two. So the answer is going to have to be B or D. Now, looking at D first, investment in bonds. If you see the word investment, it's an investment we have made. So we have gone to the market and we purchased a bond. So that is an asset. So D is an asset. Okay, I see a lot of people have chosen B. Unearned revenue is a liability. Unearned revenue is where we've collected cash and we have yet to perform the service or deliver the goods. Example of this, classic example, is a gift card. If a company sells a gift card, that is unearned revenue to them. That is a liability. They have a liability to perform, to give you the merchandise or whatever you're buying with the gift card. So until you use the gift card, that is unearned revenue. It's a liability. So the answer on this one is going to be investment in bonds. That is an asset. The other three of these are liabilities. So this question is going to stay open for a few minutes. It'll close at some future time. And I'm not going to announce it, but it'll be open for a little bit longer. Okay, so some administrative things before we go any further. You can review your exam this week with Amir, today from 1 to 4 and Tuesday from 3 to 6. I sent out an announcement email early this morning, so you have this information. He will be down in room A230, which is the other end of the second floor in the College of Business. It's past the Proctor labs for the exams. It's the room that is a little bit smaller, has double monitors. So he will be there from 1 to 4 today and 3 to 6 tomorrow, and he'll go over your exam with you, if you want to. What to do this week, Chapter 9 homework. Now, we have Veterans Day this week, which the university is closed on Wednesday in observation of Veterans Day. So what I'm going to do, we have Chapter 9 homework due this week. So I will be sending out this afternoon a list of links. We're going to hit some high points in class today. We're not going to go at breakneck speed today, just, our normal pace, but I'm going to send out links for homework and then some additional lecture, so to speak, on some of the concepts in Chapter 9. Since we're missing that day, you can watch it or not watch it as you need and as you see fit. So I'll send those links out this afternoon. So we're not able in one day to do the entire chapter, but there's not a lot left, but I'll send those links out this afternoon. Okay, so again, we do not have class Wednesday this week. The entire university is closed. Okay, so liabilities. We're starting at the top of the liability section. So our conversation, the first part of class, for the first big chunk of class, is going to be about current liabilities. Liabilities are split up into two groups. We have current liabilities, which are liabilities that are going to be due within the next 12 months. And then we have long-term, which are due more than 12 months from now. On this screen here is just, I know you can't read the individual amounts, but this is targets balance sheet. Target actually calls their balance sheet a consolidated statement of financial position, but that's their balance sheet. And at the top, it starts with assets. It goes down and into liabilities and stockholders' equity. And Target, just a word of note, Target's year-end ends somewhere around February 1st. I don't know. I didn't look up to see how they define it, but they define their year-end as something like the first Saturday in February or something like that. So their year-end date, closing date, will change year to year. In 2013, it was February 2nd. In 2014, it was February 1st. So what Target does is it picked a different fiscal year than a calendar year, and that's a lot of retailers do, because what Target's saying, well, gee, we make all these sales through the holiday season, and then the month of January, we have a lot of returns related to the sales we made in the fall. So we're going to wait to close our fiscal year until somewhere at the beginning of February. And so that's how they've come up with their fiscal year. The university, on the other hand, has a fiscal year ending June 30th because it would make no sense for the university to close their financial year right in the middle of an academic year. So companies will pick different years depending on their own operating cycle and what business they're in. Companies can pick any operating year they want, any year end they want, but once you pick it, you stick with it. So you're not changing year to year when you close. So it's always a given date. Okay, so Target. Target, we have liability section. So here we're looking at it in a little more detail. We have the numbers on the right-hand side, but we have, I'm going to blow up the words now. So this is Target's liability section, and this isn't anything you need to write down, but it's just showing you that these are the kind of things that we're going to see in this chapter. This is a typical balance sheet. We start with, in the liability section, accounts payable. That is always the first one. I can't remember seeing anything where accounts payable wasn't the first one. Accounts payable, we're buying inventory from other vendors for resale. It's just business to business, pretty short, quick terms. So accounts payable, that's a liability. Then below that, we have accrued and other current liabilities. These are liabilities of wide variety in this bucket. Now, companies have financial statements, which they have 4 financial statements in the balance sheet, the income statement, etc. As an investor, as a user of the financial statements, you can't just look at the numbers. You have to look at, there's also notes included with the financial statements. And this is an example of a note. We have accrued and other current liabilities, and as an investor, I would say, what is that? So if I go back in the notes, there'll be a section in the note that tells me, note 16, tells me that accrued and other liabilities include wages accrued, taxes payable, gift card liability. So Target calls its unearned revenue gift card liability. And we'll see some different names for that today. So it'll tell you what's in there. And then continuing down, we have something called the current portion of long-term debt, and we have long-term debt. Basically, we split our long-term debt into what's due more than a year from now and what's due in the next 12 months, and that's what the current portion is, and we'll talk about that. And then down at the bottom, we have deferred income taxes and other non-current liabilities. So we have, Target has a wide variety of liabilities. We can dig in the financial statements and get more information about all of those. Okay, so I just wanted to show you in real life, these liabilities that we're talking about in here do appear on companies' financial statements, and we'll have some other examples. Now, current liabilities. So we're in current liabilities for the first portion of class here, and these are liabilities that are due within a year. Okay, and we can have 2 types of these. We can have known amounts and estimated amounts. Basically, do we know the dollar amount with certainty, or do we have to guess at it? And we're going to start with the known amounts first. So we're going to go through some examples. First of all, I'm not going to cover accounts payable because we've done that before. So these are some examples of known amount liabilities, current liabilities. So we have accounts payable. That's where we're buying business to business. We have short-term notes payable. We have sales tax payable, accrued liabilities, payroll liabilities, unearned revenues, and current portion of long-term debt. If you're using the PowerPoint slides today, we will do a little bit of skipping around, but all of these slides are in there. Yeah, we're going to walk through examples of all of these types, except for accounts payable. Accounts payable we've covered in prior chapters, where we would say, for example, purchase inventory on account. We would debit inventory, credit accounts payable. So accounts payable, whenever we purchased anything on account, that was where we were using accounts payable. So that one's straightforward. Some of these other ones are newer to us, so we're going to be going through each one of them, starting with short-term notes payable. Okay, notes payable can be long-term or short-term, but a short-term note payable, it's due within a year, and we can borrow cash. If we go to borrow cash from the bank for less than a year or less, that's a short-term note payable. We can also have a short-term note payable if we go to buy equipment and the seller offers to finance it. If you go to buy a forklift, a lot of times the forklift companies will say, sure, take the forklift, sign this promissory note, and pay us back in 12 months or something. So they'll provide financing, and you're responsible for paying it back. A short-term note payable, how a note payable differs from accounts payable is a note payable has a signed promissory note, and it has interest on it. Accounts payable typically doesn't have interest on it if you pay within the terms of it. Okay. Short-term note payable, you have to accrue interest on it in between at the end of the period, and we're going to go through an example of this. So, example, let's say we bought inventory with an $8,000 note. Okay, common thing that the seller is providing financing, but the seller's not providing financing out of the goodness of their heart. The seller wants to earn some interest for extending financing. So we purchased inventory that cost $8,000. It's a 10% note payable due in a year. Okay, and this is January 1st that this is occurring. So those are all facts given to us. So when we first do this note, what we're going to do to issue the note is we're going to debit inventory because we're getting inventory. So we're going to debit inventory because we're getting inventory for the note. We could debit cash if we were borrowing cash, but we're going to debit inventory for the $8,000, and then we're going to credit the liability or credit short-term note payable for $8,000. Notes payable, liabilities have normal credit balances, liabilities increase with credits. So this is the journal entry when we first take out a note. We're going to debit something. We're going to debit inventory. We're going to debit cash. We're going to debit equipment. We're debiting whatever we're getting. And then our credit is to recognize that we have a liability. Okay, now, so our first entry, note that this is January 1st. We did the note on January 1st. It's a one-year note. Now, fast forward to September 30th. September 30th is this company's year end. So September 30th, we have this note. We're going to pay interest on January 1 when the note's done. But September 30th, we need to accrue interest for the period of time that we've held the note, that we borrowed the money. We borrowed the money January 1st, so we will have to pay interest on January through September. Even though we're physically not paying the interest until the maturity of the note, we need to accrue for it here. So what we're going to be doing is we're going to debit interest expense, and we're going to take the amount of the note times the interest rate times the period of the year, the portion of the year. So it'll be $8,000, it's the face value of our note, times the 10% interest rate times 9 months out of 12. This is September 30th, our year-end cutoff. We've held the note 9 months. When we do notes in here, we'll do number of months, so you don't have to worry about how many days. It'll be number of months. Also, whenever you see a percentage on a note or a bond, and this doesn't apply just to this class, but if you're looking at things, bonds that are listed in the Wall Street Journal, the interest rate that's quoted on them is an annual rate always. So we could have a 6-month note saying 10%. That's 10% for a year. So you always have to make the adjustment. So know that when interest rates are quoted, they are an annual rate. Okay, so we have said we have interest expense for this period of January 1 to September 30th, and then we're going to credit a liability called interest payable. Interest payable is a short-term or current liability. It's interest that we owe that we will be paying at a later date, but as of the financial statement date, we want to reflect that we did borrow this money. We had the money outstanding for 9 months. So we had interest expense associated with that, even though we physically won't pay the cash till January. Okay, so this is the accrual entry, and some of these are going to look familiar because we've done them in earlier chapters, so there is some overlap. Okay, and now January 1st. So we took this note out January 1st, 2014. It's now January 1st, 2015. We are going to pay off the note. So when we pay off the note, a couple things are going to happen. First of all, we're going to wipe out our original liability. So when we took out the note originally, we had short-term note payable. It was sitting there as a liability, as credit. We're going to debit it to get it off our books. So the original $8,000 is coming off because we don't owe it anymore. Next up, we need to get rid of that interest payable, that accrual entry that we just did September 30th. We said we owed $600 for the first 9 months. We want to get rid of that. And then the other thing happening here is we have interest expense on this note that we haven't recognized yet. And the interest expense we haven't recognized yet is October, November, and December. So we have 3 months of interest expense since the accrual entry. So we're going to debit interest expense for $8,000 times the 10% times 3 months out of 12. Now, we can add all our debits up, and we will get $8,800. So what we're going to be doing is, what do we pay the note off with? We pay the note off with cash. So we're going to have a cash for credit of $8,800. So we'll see the $8,800. Another way to get the $8,800, just as a double check, is it's the principal of $8,000 plus 10% interest. This was a 1-year note, so 10% of $8,000 is $800. So $800 plus $8,000 gives us the $8,800 cash that we're going to pay. So those are the 3 journal entries we pretty much need with notes payable, short-term notes payable. Okay, so moving on then to sales tax. I like that question, so I'm going to take it. Okay, so the question is, why for interest can't you do the same as we did cash? Why is interest 2 different entries? Going back to this, the reason interest is 2 different entries, because September 30th, we issued our financial statements, and we had to say $600 of interest belongs in that fiscal year, because that's when we use that money for 9 months of it. So now, when we're paying off the note, we need to pay off the liability. We have a liability right now on January 1st, before this entry, of $600 interest payable. Once we pay this note off, we don't owe that $600 anymore. We also need to acknowledge that we have interest expense for the 3 months since the financial statement accrual. So we had interest for November, October, November, and December. So it's because we did the accrual mid-year that we need to wipe out the accrual entry, first of all, and then recognize the interest since that date. And you can add to it if you want after that. So, okay. Okay, so sales tax. So sales tax, this is we go to the store, sales tax is levied on several items that we buy. And sales tax is collected from customers and remitted to the state. So sales tax is never revenue for a company. So here's our example. Let's say Home Depot has sales, let's assume it's all cash to make it easy, of $200,000 in a given day. Let's assume the sales tax rate is 5%. So Home Depot had sales revenue of $200,000. It had sales tax of $10,000, which would be 5% of the $200,000. So what Home Depot is going to do is, first of all, cash is going to be the 100%, the $200,000 plus the 5%. As a shortcut, you can do 100% plus 5% sales tax to make it 1.05. So the cash that Home Depot would have collected that day, if you went through and added up all the sales, all the receipts of cash, it would be $210,000. $200,000 of that is sales revenue, and sales tax payable is $10,000 of that. So the sales tax that's on your receipt is never revenue for the company. That is always recognized as a liability. And it's a pretty serious liability. If you don't remit sales taxes to the state in a timely manner, there's huge penalties, and you can actually end up going out of business if you don't remit sales tax payable, if you don't remit your payroll taxes. So those are pretty serious liabilities there. So when you sell something and there's tax on it, the amount of the sales revenue is the amount without the sales tax. The sales tax is a liability by itself. Okay, next category, accrued liabilities. Accrued liabilities can be a lot of different things. We can have sales and wages payable. We did accrual entries back in Chapter 3. So that relates to sales and wages payable. If we had a payroll that, let's say December 31st is on a Wednesday and our payroll ends Friday, we're going to have to accrue wages for the portion that's in our last year. Interest payable, we saw it just on that one where we had interest on a note payable. Income taxes payable. At the end of the year, a company needs to calculate its income taxes, even if it's not going to pay then, if it'll pay later, it still needs to accrue income taxes payable. So the income tax expense is in the year in which they earned the revenue. Okay, the next category was payroll liabilities, and payroll liabilities are the wages and salaries and bonus and commissions like that, and then you have the payroll taxes. So those are a form of current liabilities as well. So the next big category we get to is unearned revenues. Unearned revenues. So unearned revenues are current liabilities. Unearned revenues can be called a wide range of things. We saw in Target's little balance sheet, their notes, they call their unearned revenue gift card revenue or gift cards liability. Gift card liability to them is the gift cards that people have purchased and have not yet used. The business in a unearned revenue situation, the business receives cash before earning the revenue. If you receive cash and you have yet to provide this goods or service, that is a liability. You have an obligation to provide the goods or provide the service. We're going to go through an example of unearned revenue. We're going to use an airline. Okay, So, unearned revenue. This is Southwest Airlines. So on December 15th, Southwest Airlines collects $300 for a round-trip ticket from Dallas to LA. So on December 15th, Southwest has not done anything other than collect cash. So December 15th, Southwest is going to show cash, increasing their assets for $300, and increasing their liabilities. Now, Southwest calls this air traffic liability. It's unearned revenue. Unearned revenue can be called different things, but this is air traffic liability. This says we have a liability to provide this flight for this ticket that this person purchased. So December 15th, when the ticket sold, and it's a round-trip ticket. So December 28th, the customer flies from Dallas to LA. So they have now completed half of the ticket. So it was for a round trip. So what they're going to do on December 28th is Southwest is going to recognize that they've earned half that flight revenue, and they no longer have a liability for the full amount. So the ticket was $300. So since half the journey has been completed, Southwest will debit the liability for $150, half of the original ticket, and then credit ticket revenue for the $150 as well. So you don't get to recognize income until you actually earn it, until you do the thing, you deliver the goods or services. So right at this point in time, at the end of the year, Southwest would have a liability for $150 for that ticket that they have not yet performed the flight, had that flight yet. So what's going to happen on January 4th when the customer flies back from LA to Dallas is Southwest is going to debit the liability, air traffic liability, and credit ticket revenue. So they'll have $150 in 2015. So if we look at the liability for air traffic liability, we started with the $300 when we sold the ticket. We had a liability, and then we earned $150 of it when the customer made the first flight, and then we earned another $150. And every time we earn the revenue, it reduces the liability. And after the flight on January 4th, zero liability because we've performed the flight. The flight's done. Okay. The next category is current portion of long-term debt. So when a company has long-term debt, it will have debt that just like we can have mortgages or loan payments over a long period of time, companies can have long-term debt where they're making installments on it, where they're making a monthly payment. Now that long-term debt, everything that's due over a year, that's all long-term. But there is amount that is due in the next 12 months. Every year we have to reclassify some of that long-term debt as current. And the amount that we reclassify is the principal. Okay? And I put this word in big letters for a reason. Okay? So we go through and we say, well, here's the principal on what we owe. Here's the amount of principal we'll be paying over the next 12 months. We're going to reclassify that as current portion of long-term debt. We do not reclassify the future interest that we're going to pay because we don't owe it yet. So we're just talking about the principal we owe over the next 12 months, and that will be reclassified as current portion of long-term debt, and that's how it shows on our statement. I want to emphasize the word principal because we're going to have a Learning Catalytics question coming up soon, and it's going to be a true-false question, and it's going to be asking about current portion of long-term debt. What do we reclassify? And the answer is, what do we reclassify? It's principal. If it were me sitting in class right now, I'd put little asterisks around the word principal, okay? So you want to keep that in mind. Current portion of long-term debt is the principal that we're going to owe, that we owe, and it's what we're going to be paying off in the next 12 months. Okay, and so we'll see that again coming up. But it is the principal portion, not the interest portion. Okay, so we went through a bunch of current liabilities that are of known amounts, meaning we know how much they're going to be. Now we're hitting the estimated. These are ones that we need to make estimated guesses about, educated guesses about. But the first category is estimated warranty payable. So when we sell products, oftentimes we sell them with a warranty. And the warranty could be 30 days, 90 days, a year, 5 years. So when we make the sale, we need to estimate what it's going to cost us to perform on that warranty. Now, companies have historic dollars. They know their failure rate. They know that. That shouldn't come as a big surprise normally. And what they'll do is they will record warranty expense in the period in which they make the sale. So we're saying if we sell the item this period, we want to recognize all the expenses of that item this period as well, even though the warranty might stretch out into a future period. So companies will accrue and they'll estimate what their warranty expense will be. Okay, so that's one category of estimated amount liabilities. The next category is contingent liabilities. And contingent liabilities, basically, it's a potential liability given the outcome of something related to the past, but we don't know it yet. There's 3 ways that we can deal with contingent liabilities. We can accrue, we can disclose, and neither, in a nutshell. I'm going to expand on it in just a minute with an example. Okay, contingent liabilities. So I'm going to expand on what we do with these. So contingent liabilities are, it's a potential liability that may or may not occur based on some past event. So contingent liabilities. So we're going to expand on that. So there's basically 3 accounting treatments we can have. The 3 accounting treatments are in the far column. So we can accrue, we can disclose, or we can do nothing. Okay? And there's rules about which we do. If it's probable, I guess I'll draw the arrows, and then I'm going to talk about Volkswagen, because Volkswagen is an excellent example of contingent liabilities. If it's probable that we can, that we are going to have this liability, and we can reasonably estimate it, we're going to accrue it, meaning we're going to put a liability on our balance sheet. And we're going to disclose it, meaning we're going to talk about it in the notes to the financial statements. So for us to recognize a liability, it has to be probable that we're going to have to pay it, and it has to be, we have to be able to estimate it. If neither one, so let's talk about Volkswagen. Volkswagen has made the news virtually every day for cheating on their emissions standards. So they had software that would cheat it so it looked like they were complying with emission standards, and they willfully did this, and they were caught finally. And now every day it seems like something else is coming out about Volkswagen. So Volkswagen is Volkswagen, it's already said that it plans to pay each owner of the vehicle a certain amount of money. Okay, so that's Volkswagen coming out and saying. So Volkswagen, if we were to look at their financial statements when they issue them, so if we were to look at them, they would have, it would be probable that they're going to pay this amount to each owner because they've got some liability there because they misrepresented and intentionally misrepresented, and they can probably reasonably estimate it. Right now, it seems like their tab is growing daily. They have come out and said they are accruing at the moment something like $4 to $6 billion for liability for this emissions work, and so they're paying owners of vehicles. So that is probable. They're going to pay it. They're saying they're going to pay it, and they can estimate it because they've come up with an estimate. Now, it's a moving target because it seems like that estimate is growing daily as they find more issues. So that is a contingent liability. Volkswagen has a contingent liability. It's based on past events. That means that they did this in the past, and now they're saying, yes, we're probably going to have to pay. Now, reasonably possible. Reasonably possible says, okay, it's reasonably possible we're going to have this liability, but we can't estimate it. It's not probable, but it's reasonably possible. So again, back to Volkswagen. Volkswagen is probably going to be subject to some penalties from various regulatory bodies. Now, those regulatory bodies, there's regulatory bodies coming out of the woodwork to sue Volkswagen. So Volkswagen is acknowledging that they've got to, that it's reasonably possible they're going to have to pay regulatory fines and penalties, but they have no way of knowing how much those are. So with those are reasonably possible, so they're going to disclose those. So that category where they don't know how much it is and they're not totally sure, but it's reasonably possible, and believe me, Volkswagen is going to get penalized. They just can't, they don't know how much. So they'll disclose that, meaning that in their financial statements, you open it up to the box, the notes, and you go down to contingent liabilities, and I'll tell you all about this. And then the third category, remote. So let's say Volkswagen has a lawsuit pending, and let's say this is from a dissatisfied owner who feels that that the color of their car is not right. They wanted a different color and they felt dissatisfied. Well, that's a remote chance that they'll lose that one, so they don't even disclose that. So if it's a frivolous lawsuit or they just don't, the lawsuit doesn't have any merit, they don't have to disclose it. In my opinion, one of the most interesting parts of an annual report is to open up the notes and read about contingent liabilities, because companies are going to tell you about the things that are probable and they can estimate, and you'll see the liability sitting on their balance sheet. Volkswagen has a liability of $4 to $6 billion so far connected with this, and then you'll read further about what they think is reasonably possible, but that's not on the balance sheet yet because they can't estimate it. So contingent liability section is fascinating, and you can get some insight on what's going on major, what's on their radar. And Volkswagen is, unfortunately, a really good example of contingent liabilities right now. Okay. Okay, so we have a question, and okay. So again, I want to point out on this question, before you answer, be very careful to note, because this is the one that I said you're going to hear about it. Note that this question talks about the current portion of long-term debt refers to the amount of interest. So I want to emphasize that word, interest, versus what we just talked about. This is that one that I told you, write it in your notes, put little stars around it. What was that word? Okay, true or false? The current portion of long-term debt refers to the amount of interest on a note payable that must be paid in the current year. That refers back to that note that I said to put little stars next to that word. True or false? We're going to close this in about 10 seconds. Okay, and that is false because it's the principal. Current portion of long-term debt refers to the principal amount. Next one. All contingent liabilities, so those are the things that we're talking about, lawsuits, all those kind of things. Contingent liabilities should be reported in the financial statements, meaning reported. Are they listed in the financial statements? Even those that are unlikely to occur, unlikely, remote chance, should all contingent liabilities be reported in the financial statements? True or false? when you're thinking about this one, think to yourself, when I'm talking about unlikely to occur, this is frivolous lawsuits. Do companies disclose every single contingent liability, including frivolous lawsuits? Because frivolous lawsuits, unlikely to occur, remote chance. Okay. True or false? Do we report every single contingent liability in the financial statements, including things that are unlikely to occur, like frivolous lawsuits? True or false? I'm going to close this in about 10 seconds. Okay, that's false. We don't disclose things that are remote. We don't disclose frivolous lawsuits because the volume, it wouldn't mean anything to investors. Why disclose something if it's not going to, there's very little chance of it occurring. So that would be false. Okay, we've got a few of these going here. Okay, all the following are reported as current liabilities except for, so current liability means due within a year. And we talked about 3 of these right now, recently. Okay, let me give you a huge hint on this one. So the question is asking which of the following are current liabilities? Okay, so current liability means due within a year, so in the next year. The very first one, bonds payable, unless told otherwise, bonds are always long-term. Okay, so unless told otherwise, you treat a bond as long-term. Okay, we're going to close this in about 10 seconds, so get your answer in. Okay, and that is bonds payable, because bonds payable is long-term. Okay, now question 7, I'm going to give you a freebie to help boost the percentage today for those of you. Which of the following is not usually an accrued liability? Which one do we not accrue for? Accrue means do an adjusting journal entry to recognize this amount. So interest payable cannot be the answer because we accrue for interest, so that will be the answer. Wages payable, we absolutely have to accrue wages if the payroll period is between the year end. So it can't be that. We absolutely have to accrue taxes payable, okay? So the first 3 are all accrued. So by default, it has to be notes payable. Notes payable, we don't have to accrue a note payable. When we make the note, when we borrow the money, we sign it, we have the note payable. It stays on our books until we pay it off. So notes payable is not an accrued liability. The other ones are. Okay. Right. The note still accrues interest, but that's interest payable. So the interest payable is the accrual part, but the note itself is not an accrual. Pardon me? The note is the principal portion, yes. So we have interest payable as that separate portion. Yeah. Okay. And one more. This one, I'm going to give, okay, when I deliver this, your A will say something different. So substitute my A when you're answering this. So, okay. And actually, I'm going to give you the answer for this, but I wanted to point out that discrepancy, and we'll talk about why. So you're going to have to answer C. So answer C, and I'm going to talk about this why it is. Okay, when we accrue a liability every time we accrue a liability, we're going to debit an expense, and we're going to credit the liability. So when we go through here, this is where I said understate income. If we don't make this entry, if we don't make the entry that's in the box, we will have too little expense, which means income will be overstated. If we don't accrue this liability, liabilities will be too low, so understate liabilities. So the answer here is understate liability. And again, the question you have has a different answer for A. There were actually two answers the first time when I did this, so I corrected this one. So your answer should be C. If you don't record accrued liability, you're understating your liabilities. You're not recognizing that liability that you have. You're also not recognizing the expense you have. You'll be overstating income. Okay, that one's done. Okay, now we're moving on. So we're out of current liabilities. Now we're into long-term liabilities. We're talking about bonds payable for the most part. Now notes payable could be short-term or long-term, but bonds are typically long-term. We're going to talk about bonds. Now, this is the area that we're not going to cover everything in here today. And it would just be too much to cram in one day. So I've got some small videos that I'm sending out so you can read this portion of the book, or you can watch the videos or do both. It's up to you. But we're going to cover some of this, but no, we will not cover everything. So bonds. So we're going to talk about bonds. Bonds are what companies issue to borrow money. In effect, companies can go to a bank for some financing, but bank financing is the most expensive financing typically for a company. A company that has a large company that has a credit rating, all that, typically can borrow by issuing bonds. A company can also raise money by issuing equity, and their entire course is on the theory behind how much bonds and how much equity to issue. But we're going with, if a company is issuing bonds, here's what happens. So a company issues bonds to borrow money. So what they do is they'll issue a bond, typically in increments of $1,000, and these bonds will have a stated interest rate on them. And the stated interest rate is how much the company is paying. They pay interest twice a year, typically, and the interest rate on the bond is a full year's interest. Always, when you see percentages on bonds or notes, they're always for a full year. So if interest is paid twice a year, it's half of that interest rate. Okay, so there are two rates when we're talking about bonds. There is a stated rate. It's also called the coupon rate. The stated rate is what the company says they're going to pay for interest. That is done when they originally issue the bonds. They will say, these are 5% bonds, and that rate will not change. So the bonds will always pay 5%, half of that every 6 months for the life of the bonds. So the stated or coupon rate does not change. And that's the amount of cash the company is going to pay to the bondholders every 6 months. The other interest rate here is the market interest rate. And the market interest rate is what is being paid on the market. That's what investors are demanding for their money. The stated rate and the market rate are usually different. The market rate varies minute to minute. The market rate varies also depending on what credit rating you have. If you're a very stellar company with very little chance of default, your market rate for that bond is going to be a little bit lower than a company that is a lot more risky. So market rate isn't one rate somewhere. It just varies depending on the industry you're in. But on Wall Street, so they have algorithms to price all these things. So when your bond hits the market, it has, when you issue your bond, when you want investors to pay you money for your bond, you're paying a rate. It's called its stated rate. There's a market rate, and the two of them interact together to determine what the market will pay for your bond. Okay? So Okay, so let's talk about the situation. We have three potential possibilities. We have the market rate and the stated rate. So case A, we have the stated rate, which is the coupon rate on the bond, is equal to the market rate. Okay, so that's not going to happen very often, but that is said to be issued at par. So if market rate equals stated rate, then your bond, if it's a $1,000 bond, it's going to sell for $1,000. That's par. Par value is face value of the bond. Okay, now, next situation down. Next situation down, our stated rate. So this is what our bond pays, is less than the market rate. So let's put some numbers on here. Let's say our bond's paying 5% and the market's paying 8%. No one is going to buy our bonds because as an investor, I would not want to buy a bond that was paying 5% if I could get 8% from the next one. No one would buy it. So to make people entice people to buy our bonds, we sell them at a discount, which means we sell them less than their face value. So I have a $1,000 bond, maybe I sell it for $900, so you give me $900, and I give you a promise to pay you at the end of the bond $1,000. So you've just issued a bond at a discount, and that's an enticement for me to buy your bond because your interest rate is lower than what I can get from all the other bonds. And that's how they price bonds. They make it so they kind of equalize the market rate. It's called an effective interest rate on it. So that's case B. Your stated rate is less than your market rate, which market rate's what we could get from everyone out, what everyone on the market's paying. If our stated rate's less than that, for anybody to buy our bond, we're going to have to sell at a discount. Okay? So then the third case, case C, our stated rate is greater than the market rate. So let's say the market rate is 5% and our bond's 7%. Then we can command extra, so our bond would sell at a premium. Wall Street has algorithms built in that price these things. They equalize them, the market rate and the stated rate, and determine do they sell at a premium or a discount. And so you have to know if the stated rate on the bond is greater than the market rate, you'll get a premium. You'll be sold at a premium. If the stated rate on your bond, what your bond's paying, is less than the market rate, you have to sell at a discount. So we're going to do some of the accounting for that. Okay, so when we price bonds, so Wall Street prices bonds based on this market rate and the stated rate. So the quotes are always as a percent of par or percent of face value. So the quoted price would be 100. That would be something sold at face value. So the face value bond is a $1,000 bond, okay? And if it's quoted at 100, it's sold at the $1,000 bond is sold at 100% of its par. So its par value, face value is 1,000. So this is sold at par. That's the easiest one. So price is always a percent of par. So 100% or percent of face, same thing. So we sell it at par. Now, next one down, example. If it's a 101.5, that's saying that this is selling at a premium because it's above par. It's above 100. And that's saying that we're selling at 101.5% of the face value. So what we'll do here is $1,015 is what it would sell for. We'll take the face value of 1,000 times 1.015, and that will give us what this bond sells for, and that's so to be selling at a premium because it's selling for more than the face value of the bond. Okay, and then our final one here, our final case, it's below 100%. This is at 88.375% of the face. So we take 0.88375 times 1,000 to give us the selling price of $883.75, and that's said to be at a discount. Okay, so those are bond prices. A bond at par is the easiest situation because you're selling it for the face value. It's easy. Premium and discounts require a little more work, and that's where we go with this next one. A premium. A premium, the premium column, the left-hand column here, the price is above the face value. The premium, the difference between the face value and what we sell it for, that's the premium. That has a credit balance. Liabilities have normal credit balances, so premium would have a credit balance. And over time, that the market price will get closer and closer to market. It will decrease closer we get to market value as we get to maturity. The discount, the price is below face. The discount itself has a debit balance, and the market price will increase towards maturity value. Because as you get closer and closer to maturity, the difference in interest rate is not as significant because you don't have as many years involved. At maturity, the face value will equal the market value. Okay, we're going to go through an example. So we're going to use Southwest Airlines, but now it's issuing bonds. And this is an example of bonds issued at par. So suppose Southwest Airlines has $50,000. So $50,000 is the face value. $50,000 of 9% bonds. So the 9% means these bonds are paying 9% a year. Assume that Southwest issues these bonds at par. So to figure the bond issue price, it's at par, it's going to be the $50,000. So whenever we're at par, we can just take the face value of the bonds and be done with it. We would typically, if we have a premium or discount, we need to figure out the bond price with the percentage quote. To issue these bonds at par, we're going to debit cash. They're selling $50,000 of bonds, so the investors are giving Southwest $50,000 cash, and then Southwest now has a liability, bonds payable, for $50,000. These are 5-year bonds, so these are considered long-term bonds. Most bonds are long-term, so we're going to have debit cash, credit, bonds payable. So that's to issue bonds. Now, these bonds pay interest. They pay 9% a year. Typically, bonds pay interest semi-annually, so twice a year. So it tells us now on the next page, interest payments occur each January 1st and July 1st. So we need to record the first interest payment. So the interest payment on this bond is going to be the face value of the bond, the $50,000, times the 9% rate. And then since these are twice a year, we take 6 months out of 12, or 1/2. So it's $2,250. So when Southwest pays the interest on these bonds, they're going to be debiting interest expense for the $2,250 and crediting cash because they're paying the interest rate, paying the interest on the bonds. Okay, so question 9. Question 9 relates to a bond with a face value of $1,000 and a quoted price of $102 has a selling price of $1,020. True or false? Okay, now when we see this, that quoted price of $102, that means 102% of the face value. 102% is the same as 1.02. So if you take 1.02 times 1,000, that'll get you what this bond selling price is. So you take the 1.02 times 1,000, get the selling price, enter true or false, and we'll have this open for another 10 seconds or so. Again, make sure when you're answering this, it's pretty simple. It's 1.02 times 1,000. Okay. So that is true, because that's at 1.02 times 1,000 is going to give us 1,020. Okay, we're going to try another one. Okay. Now, this one, if the interest rate on a bond, so that's what the bond is paying. The stated rate on a bond is 8%, and the market rate is 7%. So everybody in the market's paying 7, our bond goes, and we're paying 8. The bond will be issued at a price above the par value of the bond, at a premium, true or false. Okay, so when we're thinking about this answer, the interest rate on the bond is 8%. This bond is paying 8%. The market, what everyone else is paying, is 7%. So when investors are looking at this bond that's paying 8%, are they going to want to pay more? I mean, is it worth more to them? And it is, right? Because if the market pays 7, so everyone else is paying 7%, and you're paying 8%, investors are going to come flock to you, and they are going to pay you an amount above par that's called a premium. They are going to pay more than par because you're paying more than the market rate. So you always look at this and say, what can they get from the market versus what's this bond paying? So in this case, the bond will be issued at a price. It is true. Okay. So I'm going to close it in about 10 seconds. Okay. So that's going to be true. Okay. So that brings us to the end of where we're going to end today. As I said, I'm going to email out a series of short little videos for the parts of the chapter we won't cover in this one day. And we will have class again Monday next week. Remember that Amir can go over your exam today or tomorrow.